Hi everyone, 90% of SCHD investors are making one catastrophic mistake, and it's costing them over $100,000 in 20 years. While you're panicking about SCHD lagging tech stocks, a small group of investors just triggered automatic dividend reinvestment at bargain prices. They understand something you missed. Tech stocks delivered massive gains. SCHD paid consistent dividends through every crash. You're about to discover why what looks like underperformance is actually the wealth transfer setup of this decade. If you sell now, you'll learn this lesson the expensive way. Stay with me. Let's address the elephant in the room. SCHD lagged tech indexes. The Magnificent Seven posted huge gains. Nvidia skyrocketed, meanwhile SCHD pays a 3.9% dividend yield quarterly. The frustration is legitimate, but you're calculating wealth wrong. Here's the hidden concentration disaster nobody discusses. The Magnificent Seven now control 35% of the entire S&P 500, not spread across 500 companies. 7 companies control more than one-third. These same 7 delivered more than half of all S&P 500 gains. But when you buy an S&P index fund thinking you're diversified, you've unknowingly placed a 35% concentrated bet on 7 stocks trading at valuations last seen during the dot-com collapse. The Buffett indicator measures 230% of GDP. That's 2.4 standard deviations above historical norms. Markets trade 77% above their long-term trend. History doesn't repeat, but it rhymes viciously. Many investors wonder if SCHD really falls less during crashes. Let me show you what this question misses entirely. During major corrections, SCHD typically falls 10 to 15% points less than the S&P 500. But 3 forces multiply that advantage. First, SCHD distributes 3.9% dividends throughout the entire decline, more than double the S&P's 1.5% yield. Second, those dividends automatically purchase additional shares at crashed valuations. You're accumulating quality companies at massive discounts without making a single decision. Third, by recovery, you own substantially more shares at a drastically lower cost basis than S&P investors. Fall less, earn more, position better. This creates the $100,000 difference. Smart investors ask about combining SCHD with growth strategies. Let's break this down by age. Under 40, deploy 50% into growth vehicles like VGT or SCHG, 30% into SCHD, 20% into bonds. Capture technology appreciation while building your income foundation early. Between 40 and 55, transition to 60% SCHD, 20% growth, 20% bonds. Capture remaining upside while protecting accumulated capital. Over 55, most people discover dividend compounding power too late. At this stage, 70% SCHD, 10% growth, 20% bonds plus cash reserves. Prioritize reliable income over unnecessary risk. Alternative approach, combine SCHD with international dividend funds like LVHI for geographic diversification plus income growth. Eliminates US-only concentration entirely. Or use equal weight S&P 500 strategies. Buy RSP or EWSP and add international exposure through VEU or VXUS. True 500 company diversification versus market cap concentration. Different path, same destination. Critical question, should you hold SCHD in taxable accounts? Tax consequences matter tremendously. SCHD dividends qualify for preferential treatment. Taxes at 0, 15, or 20% maximum depending on income brackets, not ordinary rates reaching 22 to 37%. Think about this. High earners pay 37% on bond interest or employment income. Same person pays 20% maximum on SCHD distributions. That 17-point difference compounds into massive wealth over decades. Best sequence, maximize Roth IRA allocations to SCHD first. Tax-free compounding permanently. Then overflow into taxable accounts after exhausting retirement limits. Taxable accounts trigger quarterly dividend taxes, but qualified dividend treatment at 15 to 20% beats virtually every alternative income source. Plus, SCHD's 0.06% expense ratio costs merely $6 annually per $10,000 invested. Minimal portfolio turnover generates fewer taxable events. 2 statements captured the wrong mindset perfectly. Huge daily gain S&P lost ground, but SCHD performed worse. Isn't this defensive? SCHD experiences elevated daily volatility because it emphasizes value over technology. When growth sectors sell aggressively, value frequently absorbs harder short-term hits. But zoom out. SCHD's 12% compound annual return since inception crushes most actively managed funds. If your time frame is under 5 years, you have no business holding SCHD. Period. Markets favor SCHD accumulation when everyone else chases overvalued technology. Market concentration sits at 50-year peaks. Buffett indicator flashes massive overvaluation warnings. The Magnificent Seven trade at dot-com era pricing multiples. When the inevitable correction arrives, SCHD's dividend distributions keep flowing while technology investors watch wealth evaporate. Understand this clearly. SCHD isn't purely defensive. It won't protect you like bonds, but it falls less while paying you more. SCHD provides relative defensiveness through income generation, not absolute protection. Here's something sophisticated investors notice. SCHD increases dividends 10% annually, while individual holdings raise payouts only 2 to 5%. Most growth comes from mechanical reconstitution, not organic increases. This is the feature, not the bug. SCHD mechanically rotates weaker dividend growers out while introducing superior performers. Recent reconstitutions eliminated underperformers and introduced companies demonstrating stronger dividend trajectories. This represents the discipline you should execute manually but never do. Tax consequences stop you. Emotional attachment stops you. Hope stops you. The fund executes mechanically every year. Zero emotion, zero attachment, pure results. Here's the math that changes everything. Start with $10,000 plus 100 monthly contributions. Using SCHD's historical 7 to 8% price appreciation combined with robust dividend growth through automatic reinvestment generates approximately $51,000 in 10 years. After 20 years, approximately $240,000. Without dividend reinvestment, only $132,000. The difference? $107,621. That's 81% higher returns. Triggered by clicking one button in your brokerage interface. Automatically reinvest dividends. Year 17 milestone. Your annual dividends equal your original investment amount. You've built a perpetual income machine. Some investors engineer weekly dividend payments by purchasing SCHD plus dividend aristocrats. Receive dividends nearly every week across only 14 holdings total. Let's address SCHD's so-called underperformance with brutal honesty. It's lagging during a technology bubble where 7 companies monopolize half the market's gains while trading at 50-plus times earnings. SCHD holds quality enterprises at reasonable 13 to 15 times earnings multiplies. The question isn't whether SCHD beats technology indefinitely. The question is simple. When rotation occurs, and history guarantees it will, where should your capital be positioned? Collecting 3.9% yields with intact cash flow, or watching 40 to 50% wealth destruction because you chased unsustainable valuations? Best SCHD buying opportunities arrive when everyone else declares it dead. Market concentration at 50-year records. Buffett indicator 77% above historical trend. Magnificent 7 at dot-com valuations. When this unwinds, SCHD's dividend distributions keep arriving regardless of chaos. Calculate your Magnificent 7 exposure right now. Exceeding 30% signals dangerous concentration. Young investor strategy. $10 daily supplemented with extra shares every payday. Perfect dollar cost averaging. Combine 50 to 70% growth with 30 to 50% SCHD. Balanced approach, 60% SCHD, 20% SCHG, 20% international funds. Diversification across income, growth, and geography. Pre-retirement strategy. 50% SCHD and 50% SPLV anticipating turbulence ahead. Low volatility plus quality dividends equals serious downside protection. A decade from now, you'll either celebrate taking action or regret inaction. Keep chasing the Magnificent 7, hoping you're smart enough to exit before everyone else recognizes unsustainable valuation. Or build automated income that flows regardless of market conditions. Your choice determines your outcome. Subscribe for data-driven answers, not hype. Like this if it transformed your SCHD perspective. Education only, your decisions, your responsibility, your outcomes. This content is for educational purposes only, not financial advice. All investing carries risk. Past performance doesn't guarantee future results. Consult a qualified financial advisor before making investment decisions. This is SCHD. Welcome to wealth construction that survives when everything else collapses. Smash that like button, share with someone who needs this, and subscribe for real market insights. Here's to protecting your wealth and investing smart. Profitable investing.